Rohr here with an early concise highlight on Thursday, June 11th, 2015. It's currently 7:45 a.m. U.S. Central Time. Coming to you a bit later than usual so we could see the impact of the U.S. retail sales. Very important figure. Did come in a bit stronger than expected, but the market responses are not what one might have expected, especially with the govies cleaning up. So what has all this meant to the market? And as usual, we have the S&P 500 future hourly on the left, 30-minute on the right. This is still the June future. Anyone who's already trading September should subtract $7 from any of the levels we're discussing. But the bottom line is that this market was going down on good news since late last week. Thursday was some pretty positive news that sank. Friday, you had the strong U.S. employment report that actually brought the initial slippage below the 2090 to 88 level, even though it recovered later in the day. And Monday, it just quietly melted down. It's been a very orderly sort of slippage on positive news, right to the point where by Tuesday, the market was actually testing and slipping slightly below 2,078 to 75, a key level. And this could have been substantially due to the higher rates that all the good data was bringing over on the government bond side, and of course interest rate hike anticipation from the Fed. However, we came in on Wednesday, as we noted, on some further firm news elsewhere without much out in the U.S. And even though the European markets had slid down to test some key lower objectives, they've been weaker than the U.S. and key lower supports. The U.S. came in not just back up into that 2090 to 88 area, which of course had been, kind of historically important as a congestion range. It also got right back above the failed up break at 2092 and left a fresh up break from right around 2090, as you can see. And on the back of that, already being up firmly on the day and continuing to take away the slippage below the lower runaway band that fed the break since last week, Thursday, at around mid-session, it actually managed to continue pushing up, and by mid-morning yesterday was already out above the upper runaway band, saying it could keep the bid. And indeed, it was back above the other key support that was, since the market failed off the higher attempted up break going back a couple weeks ago, the initial slippage down to 2096, that's the slippage below the 2100 level, down into 2096, was a key area, and once the market's above it, it's reinstated. So the market, in other words, seems to be back up in this whole higher trading range. That leaves the door open, even if it's going to fail once it gets there. That leaves the door open to test the failed up break above the 2019 area and the down breaks that were the tolerance above it, as we saw once it came in on Tuesday the 26th of May, back in from the week opening from the post-Memorial Day weekend trading, that the market stalled back up into these upper failed supports and down breaks back up into the 21, 20 to 23 area. And that remains resistance even if the market should get back up that far to test it at present. Again, equivalent levels in September are $7 lower on each of these, and at present, we would suspect any pullback, initial pullback, 2100 to 2096, probably could hold. And that pretty much does it for the short-term view of the S&P 500.